Well, I think that was a remarkable range of points of view that have some clear areas of agreement at the bottom. I would just add to Jeremy Siegel's anti-penultimate remarks by saying that the way I think, having written my thesis on 29 to 31, the way I think about what happened then and what happened now is that 75 years ago, dogmatics trumped pragmatics, and this time round, thank heavens, we had the reversal. Pragmatics trumped dogmatics, which leaves open the role of efficient market theory. But before I open the floor for questions, and we do have a special dispensation from Rob to have 20 minutes worth of questions and go a little beyond 12:45, I do want to check on the efficiency of the local market by taking bids on this watch. Is this Rob's watch? I think it may be. If not, those who own this Rolex, the owner of this Rolex will please make a line to the left after we complete this session in 20 minutes. So with that, yes, first question is, I think, Duncan Foley, and who needs a microphone, and then the next one will be right in front of him. I hope this is not an act of a coordinated market rigging.
This is sort of a very brief poll, but I'd just like to ask all of the panelists to answer two questions. One is, do you believe that there are any determinants of the total cash flow that's distributed through the financial markets, either at the national or international level? And if so, what do you think those determinants are? And a related question, which is connected to things that were discussed, if somebody manages to make a higher than average rate of return, realize a higher than average rate of return, do you believe that means that somebody else had to get a lower than average rate of return during the same relevant period?
Okay, shall we start, George?
Okay, what was the first question I did? What was the...
The first question is, are there any overall determinants of the total cash flow being, are there any overall determinants of the total cash flow being...
I didn't hear determinants.
Total cash flow
being distributed through the financial system.
Yes. And then second, is the rate of return a zero-sum game amongst investors?
Okay. Okay. I think there must be some determinants. Yeah. If you build a model of it, you would get the answer. So my answer is yes. There's got to be. The answer to the second one is I just don't know. I don't know whether if you have somebody gets higher rate of return. I think there are certain models where if somebody gets a higher rate of return, what they're doing is they're taking it away from somebody else. And I'm worried that that is one of the things that was happening.
Marcus?
Yeah, perhaps can I just add to this? With respect to the first question, I think it depends very much where the frictions lie. Often the financial sector is there to overcome certain frictions, and if the direct lending is not very easy, so you have to go through the financial sector, so it depends very much how big the asymmetric information frictions are George worked on and other frictions, how much has to go through the financial sector. With regard to the second question, I think finance is not a zero-sum game. So often it is argued that it's a zero-sum game, but through risk sharing, if you have more efficient risk sharing, it's a positive sum game. And this way, it's not the case if somebody wins something, somebody else has to lose it. There's also a risk sharing aspect to it, and that's very important not to forget.
Michael?
I was struck as I was listening to Jeremy how similar our two views are, and it sort of connects up with the question, Duncan's question. Swings in asset markets depend on fundamentals. It's obvious to anyone who reads the Financial Times or listens to newscasts, news about fundamentals of wide array of fundamentals, from central bank announcements to housing starts to on and on and on. Even if participants are short-term, they're trying to gain short-term profits, are still looking at fundamentals. And so this is perhaps where Jeremy and we are very close, whereas the bubble view is that these swings are not based on fundamentals. They're psychology, they're madness, they're not knowing that somebody else knows that it's a bubble. But because everyone has to interpret the fundamentals with imperfect knowledge, nobody knows what the true value of assets are. We don't know what the intrinsic values are. So there's a great diversity, and that's why we need markets, because nobody knows. And so for the most part, markets do really well, and asset prices swing this way and swing that way, and fundamentals drive much of those swings, but sometimes they become excessive. And just like Jeremy suggested, that's where there's a role for policymakers to step in. Only, at the boundaries, when asset prices, if we were to look at the housing price of housing, I mean, and I'm sure many of you have seen the graph of the housing price. I mean, in the U.S., the housing prices at the aggregate level fluctuated in a range of, I don't know, between 80 and 120 for about 100 years. And then in the early 1990s, housing prices shot up to 200. It's an unbelievable graph. And so this is where perhaps we part with Jeremy. Individuals in markets understand that these departures from historical norms actually are indicators of riskiness. And our empirical work with Katerina and Søren suggests that actually risk premia are actually rising as asset prices are undergoing upswings, not falling. So it's really very hard to reconcile the EMH view. The argument there is risk was falling and therefore asset prices are going up. But actually, if you, for example, look in the foreign exchange market, and there's actually some graphs that we have in our paper, the exact opposite is happening. As asset prices are getting far away from common estimates of benchmark levels, risk premia are going up, not down.
Michael, I think we're going to have to try to keep the answers as crisp as the questions, I'm afraid. Jeremy, did you want to comment on the question?
Right. I mean, one thing, in reference to your first question, I don't know what fraction goes through the financial system, but we know how critical the financial system is to the functioning of the economy, and that I think that any model, macro model, that doesn't have some sort of role of that financial system will do a very bad job at explaining short runs and cycles. As far as the second one is concerned, certainly if you've considered an indexed investment, everyone that does better, someone else is going to do worse, because if it's a weighted average index, then by definition almost that's got to be the average. But what Marcus says is so true. I mean, it's basic economics. If I trade with you, chocolate for honey doesn't mean that one person's winning and one person's losing. Sharing risks in the marketplace is exactly what markets do, because individual risks are astronomical compared to pooled risks, and that's how we're able to actually take on risk as a society. So in general, the functions of the markets are critical in that work.
Very good. So the next question was right in front of Duncan. Yes, there.
Hi, Ian MacDonald, University of Chester. Surely the main charge against the EMH in this crisis is not one just of the sentiment of the price is always right, complacency, but actually systemic, that MarktoMarket Accounting, which directly flows from the EMH, was largely responsible for magnifying the bubble and for magnifying its collapse by providing artificial increases in collateral by which the financial institutions could effectively leverage greater buying power into the market, creating a positive loop.
Anybody want to comment on the role of fair value accounting in the world that we've been living through? George?
Yeah,
Marcus? Marcus and then George.
Yeah, I agree that mark-to-market accounting has some complications. Of course, if you have on the way up mark to market, on the way down you have mark to something, that's even more problematic. You don't want to have an asymmetric treatment as well. What we wrote in the Geneva report is you want to have something which takes the funding structure into account. You want to have something which we call MarktoFunding, where it matters actually how you fund your position. If you fund your position very short term with the wholesale funding, then you have to mark on a daily basis. On the other hand, if you have long-term funding secured, you might be able to mark your positions at a more long-run basis, and you're not subject to the daily mark-to-market flows. In general, from a theoretical point of view, what the ideal accounting system should reflect is the cash flow news and not necessarily the movement in the stochastic discount factors, which is driven by some other factors as well, because then it leads to this loss spirals I was alluding to initially.
George?
Yeah, okay, I was going to just say that I thought what you said sounded exactly right.
That's good. I think was there a question here? I think that was the next question. Do we have a microphone? Do we not have a microphone?
I am Giorgio Gobe from the Bank of Italy in Rome. I want to address a question to Michael Goldberg. I mean, I take your point on excessive price swings and the prudence, in a sense, the humility of your recommendation for state action or regulation in moderating those price swings. But then you made a very strong statement, I mean, that these are not target zones. And, you know, coming from a central bank perspective and, you know, looking at questions that you're familiar with, you know, foreign exchange markets and going back to the 80s, you know, the debate on target zones. Why are you so, I mean, are you strongly opposed to target zones? I mean, is this an implication from your allusion to target zones? I mean, we are groping for solutions, right, in the G20, in the world now, and perhaps target zones wouldn't be such a bad thing.
So the question is target zones.
Yeah, the international macro literature is pretty clear on this, that target zones eventually lead to crisis. The resources of the state are just small relative to the resources of the market, and the idea of a target zone is very similar to George's playpen, to keep the price confined to this range and to fight to the death to keep it from breaching this zone. Once you recognize imperfect knowledge and recognize that price swings can sometimes be excessive, the idea is that swings are going to happen. I mean, that's what markets do. Sometimes they're excessive. We need to talk about how one judges excessiveness and this guidance range. But the idea is that once asset prices move beyond some guidance range, the idea is to dampen the excess. There's very little that the state can do to prevent asset prices from undergoing these swings. As Jeremy was suggesting, we wouldn't want to cut off we wouldn't want to cut off a swing early on because there's so much capitalism that's involved there. But sometimes asset prices can go too far, and so that's where the state starts to dampen. And for example, if in the housing market in 2005, housing prices historically were really very high. If the state started to tell people, look, you can buy your house, but you need to put 5% down now. And that would send a signal to the markets that perhaps would have dampened the excess.
I've got to give time for some more questions. We have 3 or 4 more questions available. I think here, and then there. Yes. And by the way, congratulations to the questioners for not making speeches. Let's maintain that. Do we have a microphone?
When this whole concept of diversification was mainstreamed into finance, we had segmented markets, we had capital controls, we had institutions which were not allowed to
no speech,
work across
question.
markets. Yes.
Question.
We live in a very different time now where similar risk models are operating across all institutions which operate across all markets. The pursuit of diversification has led to uniformity. So how does that inform the view the way we approach financial regulation and stability? Because it's a systemic issue, not an idiosyncratic issue anymore.
So, who wants to take that? Markus?
It refers a little bit back what I said earlier. I think it's a system. Any system is more stable if it consists of more heterogeneous entities. And that's the same is true for financial markets. So if you have a system which relies on heterogeneous forecasting models, it's on average more stable than which relies on a unified forecasting model, except if this unified forecasting model is a correct one, which is very unlikely to be true. So in this sense, some heterogeneity would make the marketplace more stable. I agree with that.
I think I've got a little bit of an answer. I think we should be careful in thinking of all of this as risk. I feel there is such a thing as risk, but I think a lot of this comes from some sort of thing like looting or taking advantage of people who don't know what they're doing and finding new ways to take advantage.
So, question right here.
Thank you. Greg Fisher. I've spent the last couple of years reading up on complexity theory. Before that, I was at the Bank of England, and I've also worked for a macro hedge fund. When I put my experience together with the reading of this new thinking, my conclusion is the EMH fails because it implicitly assumes the system is ergodic. I think Markus Brunnermeier made some related comment. But the financial system and the economy together constitutes a complex system. And therefore it is inherently non-ergodic and inherently uncertain. I think that is the core of the problem as far as I can see it. So my question is to anyone in the panel that's interested, do you agree? And second, related, is if you do, does complexity theory, should it not be at the center of a paradigm change in economics and finance?
Anybody want to address the vexed issue of ergodicity, or we could also put it into are the underlying processes, the outcome of which we observe in markets, stationary through time, through history?
I'm sorry.
Michael?
What you're saying is very close to what Roman and I are saying, because there's such incentives for individuals to find new ways of doing things, and that sort of feeds back on the process. The processes behind asset prices are not ergodic. They're not unfolding in mechanical ways. And so the real question, the second part of your question is, can we do theory? Can we write down models that recognize this non-ergodicity, this non-routine nature in which asset prices and other economic phenomena unfold? And IKE tries to provide such an alternative. Well, let me just leave it at that.
I think that it's entirely appropriate that we should conclude this conversation by, as it were, returning to the realm of reflexivity. I would just add that my takeaway from this is that Brutus was wrong. The fault I take from this is not in ourselves, that we are irrational, but in our stars, in that they populate a universe in which the second law of thermodynamics happens to hold and in which the equations don't run backwards, and all we can do is the best we can. And by and large, we do, but not always. Thanks very much.